I mean, it's not unheard of to make, 50, 60% on a note, depending on how it goes. If you end up taking back a property and selling it for cash, that's a pretty good return.
So you're known across the United States as the Canadian note guy. You're the president of Earnest Inc., the manager of the U.S.-based Earnest Investing LP Note Fund. Mm-hmm. And you're also the owner and the host of the Diversified Mortgage Expo, which is a leading annual note conference. Could you tell us kind of how you got started in all that and what got you there?
Yeah, absolutely. Yeah, glad to be here. I always like talking about notes and whatever we're doing, so I'm glad that I can be part of this. So let's see, if we go back in time, 2006, 2007, 2005, I was doing some fix and flip real estate, which I really enjoyed. It was a lot of fun. I was doing it from across the country, actually, where I would just pack up my sleeping bag and a bunch of tools, and I'd go out and fix a house and resell it, which was tons of fun. As the market started to turn, I got caught with one property that I couldn't resell. So I did what you're supposed to do, and I rented it out. And I quickly figured out that I liked the cash flow, but I didn't like anything else. It was just big headache taking care of the property. Anytime we had somebody turn over, it was actually more efficient and cheaper for me to actually fly out there with that suitcase full of tools, fix the house, whatever needed fixing, and then put it back on the market. So it was cumbersome. It was time consuming, big headache, but the cash flow was nice. So it was kind of in that light where I was introduced to a group where they had a bunch of guys from California. They got together, put their money together and bought this portfolio of properties, mostly centered in the Midwest. They didn't know anything about these properties. They didn't know anything about anything real estate. They were just, they were going to buy this portfolio, flip it out to another group. That was supposed to be the deal. Problem was they bought in April of 2007, right at like the height of the market. And by the fall of 2008, they're like, oh, shoot, what do we do? We don't know what we have. We don't know what we're doing. So they contacted a friend and I and said, you guys have some real estate experience. Can you fix this? Like, do whatever you can. Help us out. So we thought we'd invented seller financing, which is basically where you own a home and then you sell it on terms. So instead of rental, the person living in the house, they're the one taking care of the house and they're making monthly payments. But the difference is the person living in the house takes care of it, and that monthly payment, a part of that goes towards the principal to pay down the house. So it's kind of like a rent to own in that way. And that's how I got started. And it fulfilled the monthly cash flow that I liked without any of the headaches that went along with rental property. So that was kind of my introduction. And that was 2009, and I just kind of have gone from there.
So it kind of started out as seller financing, right? Which, I mean, these days, almost anyone can kind of get into.
Yeah.
How did it evolve to what you're doing now?
Yeah. So we were creating these notes, doing seller finance with these properties. And then the idea was, okay, there's got to be a way to cash out of these. So I knew you could sell like a turnkey rental property. So I'm like, well, this is, in my mind, it's even better because you don't have that rental weighing you down. You've just got the payments coming in. So doing some research, trying to figure out like how to sell these so that we could cash out of them. And it was in that research, I found a guy down in Texas where he was teaching in class, talking about buying the kind of thing that I was creating. So I'm like, oh, that's perfect. So I went down to take his class, partially to learn, partially as maybe a way in to be able to sell these notes that we'd created. And then that was kind of that introduction. So having learned about there's a secondary market for these, eventually that kind of turned into, it was probably mid-2010, where I figured I'd take a shot and buy a non-performing note. So that's a mortgage where somebody's not making payments. And at first, when I first heard about that concept, I thought that sounds super risky. That sounds like, why would you ever do that?
Right.
The advantage to it is that you buy it at a really big discount. So we're buying it I think that first set we were like 10, 15 cents on the dollar. Like it was a crazy good deal. So I'm like, yeah, it's worth a shot. And it worked. So we took over the notes, and then Um, long story short, got the people to agree to just deed over the property in exchange for wiping out the loan. And that worked extremely well. And that's called a deed in lieu. That's a technique. That's a thing you can do. And then I was, again, reselling them on terms. And then just kind of the further I went along, the more I realized owning the property is like the worst part of this whole thing that we're doing. So the further I've gone along, the more I'm like, I'll let somebody else go and create the note. I just want the payment stream. That's it. So that's just a far easier thing to manage and deal with. It just kind of morphed into that, and then growing and, meeting new people and making the right connections. And lo and behold, here we are.
Awesome. So on those non-performing mortgages, like you said, there's a big risk involved. That risk being if the owner keeps non-performing, and if they do sell you the deed, you're just going to have this house,
Yeah.
If you're going to have to sell it by yourself. Is it in good shape? Is it in a good location? So kind of how do you manage the risk associated with a non-performing loan with that investment?
Yeah, there's a few things you do up front. Like with any kind of real estate deal, you make your money when you buy. So we would do things like make sure that we knew as best we could what the value of the property is in as-is condition. So I'm not talking about like an after repair, 6 months down the road, a bunch of stuff has been done. I want to know like broken windows, broken shutters, whatever. What's the property worth today? So that was something we spent a lot of time on, just trying to determine, and to the best of our ability. Part of the risk in this was with the non-performers, you can't get inside the house. So I don't own the house, so I'm buying just the mortgage. So I can go and look around the outside of the house, but I don't know what the inside looks like. So that was really the biggest risk in that. But generally speaking, the outside reflects the inside and vice versa. So if it looked relatively well cared for on the outside, generally it was well cared for in the inside. So that was a big one. And then the other major thing that we'd look at is title, and just make sure there's no outstanding liens that lurking in the background that could bite you in the butt. So make sure we do that report before we buy anything. And it mostly works. Every once in a while, probably 1 in 90, like it's rare that things go wrong, but it can, like there are certainly times where we lost money on some of these deals, but by and large, no, we did well.
Yeah. So I guess let's speak a bit on that. Once you have the property, it's a non-performing loan, you've bought the property, it's still not doing well. When do you decide, like when's the time you say, okay, I either need to restructure this loan or I need to foreclose? Like how do you decide that?
Well, the first thing we try to determine is whether it's occupied. So if it's occupied, the people are still living there. Almost every time, if we could start a conversation with them, we could get them making payments again. They can stay in their house. We can restructure the loan however it makes sense for all parties involved. So, and that was a lot of fun because there's tons of flexibility. You can have somebody that's got $10,000 in arrears and say, okay, do you have $10,000 to bring this current? Most of the time, the answer is no. So, okay, what do you have? And maybe it's $2,000. But okay, let's put that $2,000 towards that. Now you've got a balance of $8,000. We can do all kinds of things with that. We can split that up so that you've got higher monthly payments for the next 2 years or whatever it is. Or we can tack that onto the back of the loan, or tack on part of it and forgive part of it. Or, like possibilities are endless. We can do all kinds of different things. So we're very flexible and very, fluid in what we can do versus a bank especially. So that's the first thing, determine if it's occupied. If it's not, we would start right away on a foreclosure and just to take back the property as quickly as possible, resell it, sell it on in terms again, create a new note. There's options there too.
And just to be clear, so when you're buying this loan, you're buying it from the bank, right? The homeowner has no choice on whether or not the bank or you own their loan, correct?
Right. The good news for the homeowner is I'm not a bank.
Absolutely. It's kind of a win-win situation, it seems like. So
yeah, and we saw a ton of success with that. It was a lot of fun. Markets kind of changed. There's not that many non-performing notes out there right now, which is good news and bad news. But so we're mostly looking at performing loans, which means most of the time I'm actually buying the same kind of seller finance notes that I was creating when I first started.
Mm. So these performing loans, it just means there's people that own the house and they're making the payments, right? Typically, because it's less risk, does that equate to less of a return, or how does that all work?
It does. Less of a return, however, it's far more predictable. That was one of the big caveats for the non-performers is I don't know exactly how long it's going to take. I don't know exactly how much we're going to make. You've got people where they've got emotion involved and maybe they're going this way and then all of a sudden they decide they want to do something different. So there's a lot of unknown there. But yes, definitely a higher reward on that one. This is nice though too, because it's far more predictable. If they've been making payments, they're probably going to continue to make payments. And if, those odd ones that don't, I've dealt with that a lot over the years, so we can help them get back on track.
Right. And just for numbers wise, what's kind of the return one can expect when investing in a non-performing versus a performing?
Man, non-performing is a huge variance there. It can go, anywhere from zero where you've lost money on that. I mean, it's not unheard of to make, 50, 60% on a note, depending on how it goes. If you end up taking back a property and selling it for cash, that's a pretty good return. If you sell it on terms, again, it's a bit of a lower return, but now you've got an income stream. So that one's kind of all over the place. On a performing note, again, it depends a little bit on how you do it. I'll say, like for me with our fund, I'm buying at least a 12% yield and I pay the investors 8%. So totally passive, 8% is very much achievable. If you're doing it on your own, 12%, that's reasonable.
This could be a very rare instance, but let's say, market crashes, all of a sudden your performing loans are now non-performing. Have you ever had that happen? Or if you haven't, maybe how do you think you would handle that kind of action, that kind of event?
Yeah, sure. A friend of mine, we joke about this all the time where we're looking at performing loans and we've come up through all the non-performing years. So when we're talking and looking at a note, in the back of our minds, it's like everybody's going to default. Everybody's going to stop making payments. So we're going into it with that kind of an attitude. So we've built in, some checks and balances just to be sure. So for example, throw numbers out to make it easier. Let's say the balance on the loan is $100,000. The most I would pay for that, and the house value is maybe $150,000. The most I would pay for that is $75,000. Because I want to make sure there's a big enough equity spread in there so that if they do stop making payments, there's some room there for making things up and making sure that we're still covered.
Someone out there is looking to start investing in these performing or maybe even non-performing loans. How could they get started?
Well, first thing I would say is get some education. And that's not a pitch. I don't teach. So it's really and truly, though, this is a finance game. It's real estate related, but it's not real estate. So make sure you understand finance. Make sure you understand, every state has different rules. And so it's not something I would recommend just like walking into because you got to know the rules of the game. Like I say, I know people have got colleagues that teach the business and I'd be happy to make some referrals, but make sure you understand the rules first. That being said, it's not rocket science. You just got to learn how to play the game and then you can play. Right.
Out there's so many opportunities. How does someone know where to look to find these opportunities?
For notes in general, if you're looking if you wanted to look and see what a note looks like or what kind of numbers are behind it, that kind of thing. Got some good friends of mine started up a trading platform. They call it Paperstack. So that's Paperstack with no K on the end of it. Paperstack.com. That's just like an open platform. So anybody who has notes for sale, they can list them there. People can go check it out. They actually do a really great job of really breaking down the whole process. So you get into, you make an offer and then the seller responds to the offer and maybe makes a counter. But once you start that process, there's a checklist. So buyer does this, seller does this, buyer does this, seller does this. And they really walk you through that whole process, which is fantastic.
Wow. Yeah.
But that's a place where you can go to at least, get a look at what we're talking about. Man, business in general, keep your eyes and ears open. There's so much out there. And I love that. I love that there's different things everywhere. So keep your eyes and ears open. And if it sounds like something you're interested in, go for it. There's really not much more to it, learn what you got to learn and then do it. I've seen people that just get stuck in that, well, I got to know this and I got to do that. And no, you don't. Just do it. Just do it. Be cautious, but do it. Get out there and do something.
What's kind of the entry cost someone can look like to get involved in this?
It's possible to find notes for, under 10,000 for sure. I think the least I've ever spent on a note was $500 because the balance was $2,500. And she made payments. The lady made payments for the next 2 years and then she was done. And return on my investment was phenomenal, but for a very small amount. Those are not very common. You're probably not going to find a lot of those. I would say, you're looking at least 50,000 just to get in, find something that's on a good quality house that's got good quality people in there. I would say plan on at least that. And then scaling wise, this is what banks do. So, multi-millions, billions. It's a huge, huge industry.
Right. If you have $50,000 sitting around your savings, you try to save it for your kids.
Yeah.
You could put it in a savings account, make 4%, make 5%, whatever it is nowadays. Or you could do this and make 2, 3, 4 times more than that. So it's a passive investment.
This is something that works extremely well with IRA funds. If you got money sitting in an IRA that's not doing much, this is a fantastic place to put it and just have it work for you.
Oh, yeah. What are some of those common challenges you face in this niche whenever you're working with clients or maybe just with the banks or anything in general? What are some of those challenges you face?
One of the biggest ones is finding the notes. There's lots out there, but most people don't know anything about note investing. And so it's not, real estate, whatever. You're going on to MLS and you can find whatever you want and there you go. But notes is a little bit more nuanced. There's not a lot of people that are doing it. There's not a lot of people that know about it. So making those connections is a big deal.
Why would a loan owner want to sell the loan to you and not just keep it for themselves?
Generally, the way it works is somebody's got a note. Say they have a second property, they sold it on terms, they're collecting this payment, and then now all of a sudden they've got something they want to put that money towards, whether that's, a different business opportunity or whether that's sending a kid to college, buying a boat, I don't know, whatever they want to do with that money. They would rather have that lump sum of cash today versus those payments over the next 20, 30 years. So that's really the main motivating thing is just having that lump sum today.
We'll move on to scalability. Once someone's maybe gotten into this a little bit more, how do you scale this?
So scaling that's a great question because there's a way to do it right and there's a way to do it wrong. So again, you got to know the rules. If you're going to be using somebody else's money, there's a right way and a wrong way to do that. And the wrong way can be really bad. So be very careful. This is definitely considered a securities instrument. And so, or it definitely can especially if you're taking money from multiple people, mixing that money, just by the way, that's a major no-no. And both you and the investor can both get in trouble. So it's a major no-no. So we use a company, it's called Crowdfunding Lawyers. They don't necessarily just do crowdfunding, but they set up different funds. So there's like a Reg D, 506C, 506B, a Reg A, there's, crowdfunding, there's different kinds of ways to raise money. But I would say, get with somebody professional that can walk you through that because you don't want to mess that up. You can get in a lot of trouble.
Right. And when you have these funds set up, why would the investors choose to invest in this rather than, their own real estate or stocks or something like that?
I think the major thing is just that this is totally passive. This is something they don't have to do anything. So for stocks, at the very least, you got to check in every once in a while and see what's going on. Your own real estate, that's way more involved, just time-wise and energy. So this is just your totally passive. You set it and forget it. And that's what makes it such a great IRA investment is just it's out there doing its thing and making money without you having to do anything. So that's a major thing. And then just diversification. I see this as kind of your sleep at night money where you don't have to really worry about it. It's my lawyer says I can't say guaranteed, but I can tell you we pay 8%. It's what we do. And not up to, not, perhaps, we pay 8%. So it's something that, it's going to be there, versus some other kind of project where it's projected return, perhaps at this time, perhaps not, depending on what happens, on and on and on.
So why did you decide to open this fund instead of just, personally doing it yourself? Was it just OPM, or was it just, were there more opportunities doing it like this once you're a certified business or company?
Yeah, it was something we wrestled with for a long time, but really it comes down to just scalability. I can do only so much myself, and then I'm out of money. So got to go out and borrow from other people. And it just makes sense. Then I can go out and buy much, much more. So, that being said, my fund is relatively small. It's $5 million. Still raising money for it, but that's really one of the smallest funds out there. 10, 15, 50 million is very much a thing. Those exist all over the place.
So, in those larger funds, sometimes I bet your investments can sell sooner than you expected. How do you kind of fill that gap you then have?
Yeah, so with mine, a real big part of my job is kind of watching all the different loans, and kind of moving them in and out when it's the right time. So, for example, like if I've got a loan that's a shorter timeline, say under 20 years. Mm-hmm. So for your own mortgage, you've probably seen this. The bank is supposed to supply you with this, but you've got that amortization chart. Mm-hmm. And the payment curve starts off really high and then eventually tapers off and goes down. So those first 5 years are really where you're paying the most interest, the least amount of principal. So part of what I'm looking at is I want to be able to buy the loan, collect payments for however long it makes sense to collect payments before I can resell that loan for whatever I paid for it. So I want to be able to capitalize on making sure that capital is being recycled properly and at the right time. So that's a big part of what I do.
How do you manage all those existing and prior funds you have in that portfolio?
So every note comes with servicing. So for a property, you've got your property manager, notes come with the servicer. Like the money that the borrowers are sending in, it doesn't come directly to me. It goes to the servicing company. They take care of like escrow for taxes, things like that. They send out reporting at the end of the year, those kinds of things. Plus they're licensed to take money. I'm not. So money goes to them first. They take their cut and I get everything else. And then I work with them. They send a report every month that says, actually I get it twice a month where they say, okay, everyone, paid by this date. These are the people that haven't paid yet. And then that's part of what I do as well. And just make sure that people are staying current and staying on top of their payments.
For someone looking to get started in this, what's one big piece of advice you can give them?
Oh, a big piece of advice is, this is the one that does sound like a pitch, is go to conferences. I have a conference, and so I know that sounds self-serving, but really and truly, I went to my first No conference in 2009, and that's where I started to meet people. And like I say, this is a very small group of people that do this, so you got to know who you got to know. And those are the people that go to different conferences, and the networking is massive. You really have to know people and relationships. So go to conferences, come to mine obviously, but then go to, there's 2 or 3 others during the year. And just make sure you're out there and introducing yourself and learning everything you can.
Perfect. And I guess outside of those conferences, if someone's looking to get started, what are some good resources out there that they can use?
There's a couple of good books. So kind of the grandfather of modern note investing his name is Jimmy Napier. There's a book he wrote called Invest in Debt, and it's like from like 1979 or something like that. Like it's old, so it's a little bit harder to find, but that's like the book to get started with. And his numbers are totally out of date, but the principles are true. So there's that. There are a couple of books out there, not a ton. A good friend of mine, Martin Sains, he wrote one, Note Investing Made Easier. But search out some of those kinds of things, or you can come to my podcast. There you go. So every other week, a colleague and I, we do a podcast together. JKP Holdings is his company name, and we just do it under his Facebook page. And we've got 3 years worth of episodes now, so there's lots and lots of information on there. We like to have people on to help teach us something that we don't know yet. And so that's been a lot of fun.
And if someone wants to reach out to you personally, how can they get to you?
I'd say go to the website, earnestinvesting.com, and then there's the contact page there. There's links to the conference web page, all that kind of stuff. So come and check it out. Feel free to reach out. I'm happy to talk, and I could do a lot of that. So yes, go ahead and please reach out.
Awesome. And for all those curious, those links will be down in the description below. But Nathan, you've been a great guest. Thank you for coming on today. I really appreciate it.
Hey, pleasure. Thank you.